We do not want higher inflation, and we're not tolerating higher inflation.
The core mission of every central bank is stable prices. It's a necessary precondition for economic growth and therefore then full employment, at least in some of our judgment. And you and I have talked about mandates single versus double a lot. But if we're to say that we're now going to look at the deviations between the two, and if we're saying that we think that full employment is 5.2 to 6%, we're clearly way above that, but at your PCE, we're closer to where your inflation target is. I don't know how else to interpret this, that the result of this balanced approach is that higher than preferred inflation will maybe tolerated. Not that it's desired, but that it will be tolerated. And I'll simply just quote Paul Volcker, who said in the late 1970s, central bankers who are willing to tolerate a little more inflation usually end up getting a whole lot more than they expected. My concern is that this appears less to be an inflation targeting statement than an inflation equivocation statement, because we're now targeting deviations. And that's the concern. When this statement was released, we saw a buildup of commodity prices, even though I think you've said fairly recently that demand is down, therefore commodity prices should be low. So my basic question is, if this is our interpretation and we have a spike in commodity prices that occurred after the statement released, is that not the market's interpretation of this statement?
Mr. Chairman, first of all, as we say, the two sides of the mandate are generally complementary. I mean, we agree that low inflation, low stable inflation is good for the economy, and it's good for growth, it's good for employment, and we think most of the time that there's a complementary relationship between those two. The actual results you mentioned, you discussed earlier, the responsibility of the central bank for the dollar and for the price level. Inflation currently looks to be very well controlled. Our expectation, and of course we'll adjust policy as needed, but our expectation is that inflation will be below target over the next couple of years. Of course, unanticipated events can happen. The dollar's been pretty stable for since the crisis. I don't think you should read into this any unwillingness to keep price stability as a critical goal of the central bank. All central banks, including those with a price stability mandate, take into account to some extent the overall state of the economy, but over the medium term they seek to return inflation to its objective, and that's what we're intending to do.
So let me turn to quantitative easing. The Federal Reserve has applied an unusual and unprecedented amount of monetary easing for a long period of time, not just during the crisis moments, but well after that, and now apparently through 2014. And by buying down Treasury rates, is it your view that this is putting an artificial cap on price discovery in the Treasury markets, and is that not lulling policymakers, fiscal policymakers, into a false sense of security when true price discovery in our Treasury markets, like it has in other countries, might give us the wake-up call we need to get our act in order to fix our problem? Are we not lulling ourselves in a false sense of security by this intervention in the Treasury markets?
Mr. Chairman, first, quantitative easing is very analogous to the usual monetary policy of cutting short-term interest rates. I mean, basically, that also lowers longer-term rates. It's basically a way of trying to provide more support for the economy. Our policies are hardly unusual. At this point, almost every major industrial central bank, excluding Canada, which had less of a recession than we did, has a large balance sheet and low interest rates, and including the ones with single mandates. And again, as I mentioned, we're not having any signs of higher inflation or a declining dollar. In terms of the issue relating to distorting the bond market, again, it's the objective of the policy to get rates somewhat lower to provide more support for the economy and to bring inflation up to target if necessary. But I think the basic reasons for low long-term rates, which are also a feature of every other major industrial economy, are low inflation, slow expected growth, and the fact that the dollar is a safe haven. And with problems in the world, people are investing in U.S. Treasuries because they're attractive. I think it's important for me to say that if Congress is being lulled, they shouldn't be lulled. I think we agree that attention needs to be paid to these issues, as the case of some of the countries you're referring to, like Greece and Portugal, suggests. If investors lose confidence in the fiscal policy of a country, the rates are going to go up, and there's nothing the central bank can do about that. And so obviously, it's important for Congress to address these problems, and I've spoken out about it quite consistently, as you know.
I think we would agree that we think sustainable long-run economic growth derives from savings and investment and therefore increased productivity instead of borrowing and consumption. I know you well enough to know that we more or less agree with that, but do you measure the effects that these policies have on savers, on people living on fixed income, living, on CDs? Are you concerned at all about the very, very, very low interest payments that these savers are getting from these kinds of fixed income assets, which are hitting our savings and investment side of the economy in exchange for helping the borrowing and consumption side of the economy?
We are quite aware of that issue. We hear a lot about it. We consider it. We think about it. And I recognize that for people on a fixed income or whose main income is interest on a CD, I recognize that it imposes a hardship. The purpose of our policy, though, is to create a stronger economy, and savers collectively hold all the assets, all the capital in the economy. And if you don't have a strong economy, if you have a weak economy, you're not going to get good returns on all the other assets.
My time is running out. I just want to, let me give you just a sense of this. A lot of us believe that the Federal Reserve was too loose for too long in the 2003 to 2005 period. And that is what, in part, led to the asset bubble and the malinvestment that occurred and the problems we have today. I know you don't agree with that, but because you don't agree with that, our fear is that you're just going to repeat these same mistakes again, but by orders of magnitude that we can't even comprehend right now. And that the Federal Reserve, whose primary goal is to manage our money, is involving itself in fiscal policy, is sort of bailing out fiscal policy because the branch of government in charge of fiscal policy, this branch, is not doing its job. I mean, a budget hasn't passed Congress in 2 years. We're going to pass a budget. We did one last year, but it's not passed. There's nothing in the Senate. So fiscal policy isn't being done the way it needs to be done. But that's not an excuse for the Federal Reserve to step in and try and bail us out, because that could be done at the expense of the priority, which is unique to the Federal Reserve, of maintaining our currency as a reliable store of value. And we fear that these exercises and these new ambiguous statements will compromise that. That's the point I'm trying to make. Mr. Van Hellen.
Thank you, Mr. Chairman. Dr. Bernanke, thank you for your testimony. And you laid out what I think is a very clear two-track strategy for dealing with economic growth as we move forward. The first is recognizing the fiscal and budgetary challenge that we've got. And I think there's agreement on this committee that we need to come up with a predictable, stable way to reduce our deficits and debt. We've had disagreements over how we do it, but not whether we do it. And in looking at that, I think there are two lessons, I think, from what we see happening in Europe. One, of course, is the debt crisis, that if you wait too long to address these issues, you're right. Your borrowing costs are going to go up. People are going to lose faith. And we should heed that as an early warning and not delay putting in place those predictable changes. But your testimony also pointed out that there's a danger in overreacting to that in the near term in terms of the negative impact it could have on economic growth. And the other strategy that you've laid out is the need to nurture this very fragile economy we're in right now. So if you could just briefly talk about some of the lessons we've learned from the European experience, recognizing the debt crisis is an early warning system, but the austerity only and immediately approach. Some countries can't avoid it, like Greece, because they've got themselves in a fix. But talk about the fact that a austerity only and immediate deep cuts, whether or not that can have a negative impact on the very fragile recovery that we're having now.
Well, the European situation is complicated. Among other things, of course, they have a monetary union and a fiscal disunion. They don't have the same kind of situation we have here. And you're correct also that there are some countries, like Greece, obviously, and others that have very difficult fiscal sustainability issues, and they have tried to address those in the near term. You know, I hesitate a bit to advise my colleagues in Europe, but I would cite the IMF and others that point out that very slow growth or recession makes fiscal improvement more difficult because tax revenues fall and spending automatically rises if there are social safety nets and the like. So it's important to try to figure out what the right balance is there. And I want to be very clear. I don't want anyone to interpret me as saying anything other than that this Congress has a very difficult and important job to address the long-term fiscal sustainability of our federal budget. That's a critical thing. I think that even more aggressive strategies than have been pursued recently are warranted over the longer term. But I also think that that can be done in a way which is persuasive to markets and achieves those objectives, but doesn't quite jolt the recovery quite, and it doesn't do it all, you know, all at once. I think that as long as there's a credible, strong plan over a period of time, and we move into that plan, that will achieve most of the objectives of fiscal sustainability, we need to at least avoid doing harm. I would say do no harm is an important piece of advice I would offer you. So there is a balancing act there that I think is important for us to pay attention to.